world is consuming more silver than it is producing. The electronics backbones of the AI revolution runs on silver. The real question isn't whether silver's last move is over. It is whether the conditions that created the move are over. Is silver's run over? That's the question. And honestly, it's not a bad one to ask, because earlier this year, silver made a massive move. It touched around $100 an ounce and then pulled back almost 80% before catching a bid and is now sitting just shy of about $80 per ounce. So if you missed it, you're probably wondering if you're too late. If you're holding, you may be wondering if the move is done. But here's what I want to talk about today, because I think most people actually are asking the wrong question entirely. The real question isn't whether silver's last move is over. It is whether the conditions that created the move are over. And when you look at what's actually driving silver right now, not just as a precious metal, but as an industrial metal, I think the answer might surprise you. So let's get into it. Now, before I make the case or the bull case for silver, let's be straight. Silver gets marketed constantly as a hedge against inflation, a way to protect your purchasing power from a dollar that's constantly losing value. And in the long run, it definitely is, 100% without a doubt. But when you look at the academic research, the real data going back centuries, the story is a little bit more complicated. So here's the truth. Gold is a better inflation hedge than silver. There's no doubt about that. And there's a landmark study that looked at 200 years of price data. And what it found was that gold reliably hedges against long-run inflation. Core CPI, the way that the BLS measures inflation, which we all know is not a reliable source of inflation. It's way understated in my opinion, but gold holds up, and it holds up with flying colors. Silver, it doesn't pass the test with the same flying colors. And there's a structural reason for that. It comes down to something called the stock to flow ratio. Gold is essentially indestructible. Almost every ounce of gold ever mined in human history still exists somewhere on the planet, in a vault, in jewelry, in a central bank reserve, maybe at the bottom of the ocean. That means the total stockpile of gold is enormous relative to how much new gold comes into or out of the ground each year. That's what gives gold its monetary staying power. It doesn't get used up. Silver's a little bit different. Silver gets consumed. Silver goes into solar panels. It goes into circuit boards, into electric vehicles, semiconductors, medical equipment. And with the recent boom in AI, it's only going to grow with the demand for data centers. Now, a meaningful portion of silver mined every year is gone, not sitting in a vault waiting to come back to the market. That makes silver's stock to flow ratio lower than gold's. And that's historically meant it's less reliable as a pure store of value over time or for monetary use. Now, with that being said, let's look at the actual numbers, because silver's long run track record is nothing to dismiss. And I think that by the end of the video, you may be looking to add some holdings, or if you don't invest, you may be looking to begin to invest in silver. So January 1960, silver was trading at 91 cents an ounce. Today, 2026, it's around $78 as of today or so an ounce. That's roughly an 85 times nominal increase over 66 years. Now, gold went from $35 an ounce in 1970 to over $4,800 as of today. That's almost 140 times increase. CPI, the official inflation measure, went up less than 9 times over that same period. So gold's real purchasing power increased roughly 16-fold. So let me put that plainly. A dollar held in savings in 1970 is worth about 11 cents in today's real terms. An ounce of gold held since 1970 is worth 16 times what it was in real terms. Silver tells a similar story in the long run, just with a little bit more turbulence along the way. So the long run case for precious metals beating fiat currency, that's validated without question. It's 100% real. Silver's problem isn't the direction, it's the ride, the volatility, the timing. Silver doesn't drift up steadily like some monetary savings account. It sits still for years and then it moves quickly. Here's where it gets interesting. And this is the part that I think most people fundamentally misunderstand about silver. Silver is two completely different assets living in the same metal. On one side, you have silver, the precious metal, the monetary asset, the hard money, the inflation hedge that people have stored wealth for thousands of years. On the other side, you have silver, the industrial commodity, critical to modern technology in a way that no other precious metals are. In most environments, that dual identity actually is a weakness for silver. When the economy slows down and the industrial demand drops, silver gets hit harder than gold. When there's pure financial panic, like March of 2020, silver drops 17% in a single month. Silver crashes harder because industrial demand dries up at the same time people are selling everything. But here's the thing in the current environment. Both sides of silver's identity are being pulled in the same direction at the same time. And that doesn't happen very often. So let's talk about what's actually happening right now, because it's core to the thesis. On the monetary side, the US money supply has been exploding for years. We all know this. If you're educated in the space, deficit spending is not slowing down. We all know that. It's accelerating at a rapid pace. There's no serious political will in Washington willing to cut spending meaningfully. The debt is growing. The money supply grows with it. And every dollar printed is a quiet tax on every dollar that you own. Inflation ran hot coming out of the pandemic. And while the Fed raised rates, inflation remains sticky. The official CPI in March 2026 was sitting at over 330, a lot higher than the low inflation world we remember from the 2010s. Real rates, meaning interest rates after inflation, are positive right now, which is actually a headwind for metals in the short term. But the question serious investors are asking is this: how long can that last? Because maintaining high real rates while carrying the level of debt that the United States government carries is extremely expensive. All that debt that we're rolling over is being rolled over at higher rates. At some point, the math forces a choice. Historically, when that choice gets made, real rates fall, the dollar softens, and precious metals go up. Gold leads, silver follows, usually at a much higher velocity. Now, on the industrial side, this is where silver's story in 2026 is genuinely different from any previous era. Solar energy, now one of the fastest growing energy sources on the planet. Every solar panel requires silver. The photovoltaic industry is one of the single largest and fastest growing consumers of silver in the world. And the build out of solar globally is not slowing, it's accelerating. Electric vehicles, every EV contains significantly more silver than a traditional combustion engine vehicle, and EV adoption is still in its early innings globally. As the fleet electrifies, silver demands go with it. And then there's the one that adds the fuel to the fire: artificial intelligence, data centers. Data centers require enormous amounts of hardware. That hardware, the servers, the chips, the circuit boards, the cooling systems, all of it requires silver. Semiconductors require silver. The electronics backbones of the AI revolution runs on silver. We are in the middle of one of the largest technology buildouts in human history. Every hyperscaler, every major tech company is spending hundreds of billions of dollars building out AI infrastructure, and silver is in all of that infrastructure. Now, here's the supply side of the equation, and this is critical. Most silver in the world is not mined as the primary target. It comes out of the ground as a byproduct of mining for other metals: gold, copper, zinc, lead. That means that you can't simply turn up the dial and produce more silver when the demand rises. The supply is largely tied to the economics of the other metals. It's rigid, it's slow to respond. Now, the Silver Institute, the industry body that tracks global supply and demand, has confirmed that a multi-year structural deficit has occurred. The world is consuming more silver than it is producing, and that gap is not closing because the industrial demand keeps growing and the supply can't chase it fast enough. So you have money printing, sticky inflation, potential real rate compression ahead, solar, EVs, AI, data centers, and semiconductors all consuming silver at a record and growing rates against a supply that structurally can't keep up. That is the perfect storm, and history teaches us something important about silver. Silver, it is not a gentle asset. In 79 and 80, the Hunt brothers famously tried to corner the market. Silver ran toward $50 an ounce. The exchanges changed rules. Virgins got called. Silver crashed. Move violent in both directions. In the period following 2008 crisis, the Federal Reserve launched quantitative easing, money printing on a scale the world had never seen. Real weights went negative. The dollar weakened, and silver went from under $10 an ounce all the way back to nearly 50 in 2011. Then it crashed again. Every single time silver has made a major move, it's happened when monetary fear and real demand came into alignment. Lower falling rates, a weakening dollar, and industrial or investment demand that couldn't be met fast enough by existing supply. The difference today is that those prior episodes, the industrial demand tailwind, was not nearly what it is now. Solar was tiny, EVs barely existed, AI infrastructure wasn't a concept, the semiconductor build-out wasn't what it is today. The monetary setup rhymes with 2008 to 2011, but the industrial demand picture is structurally larger. And one more thing worth watching, the gold to silver ratio. This ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, it has averaged somewhere in the range of 50 to 60 over long periods. In early 2025, that ratio hit around 100. That's an extreme reading. It means silver was historically cheap relative to gold. That's the kind of reading that has historically preceded major silver outperformance. Since then, the ratio has compressed dramatically. As of late April 2026, it's sitting around 60. Silver has made a real move. The easy money from the ratio compression has already been made. But here's the important point. If the macro thesis holds, if the money printing continues and real rates fall, and if the industrial demand keeps building, the ratio can stay compressed or compress further. 60 is not an extreme low. Silver at 78 to $80 an ounce is not an extreme price by any stretch. In a context of what's happening in the world today, the ratio is a tool, not a guarantee, but it tells you the relative story. Is silver's run over? Maybe the last leg is markets rarely go straight up if you follow markets, but the conditions that created the run, the money printing, is not over. It's getting worse. The debt, not shrinking. The dollar's long-term trajectory is not towards strength. The AI build-out, we know that's not slowing. Data centers not getting smaller. Solar installations only getting bigger. The semiconductor industry getting bigger. And silver sits at the intersection of it all as a hard asset that protects against monetary debasement, and as an industrial metal the modern technological economy physically cannot build without. That dual role, the monetary and industrial lining up simultaneously, is what makes this moment potentially different from prior cycles. Gold is the reserve, it's the anchor. Gold is where you go for stability in an unstable monetary world. But silver might be the opportunity. This might be silver's time. If I was a betting man, I would hold silver over paper promises all day. We'll see you next time.